How does a market crash upwards? How do we end up with an upwards crash? It's a downwards crash. Let's talk about an upwards crash. There's a few different hypotheses and theories that I have for this, but one is, let's just use a car, for example, and then we'll get back to the fundamentals of the economy and the business. A car doesn't blow up when you drive it slow. Let's just think of the car as the engine. And I know I'm using two different analogies here. I promise I'll get back. Think of a car as an engine. When you push it to its limit, that's when it blows up. It overheats. You could overheat your engine, for example. It gets too hot, then it blows up. I think, and this is one of the things we've been talking about in our Discord, is that the only way we're going to actually get a crash due to this super high inflationary environment that we're in, everybody's talking about high interest rates, all of these things, how that should give a forward-looking downward pressure on prices because money's harder to get, and when money's harder to get, it's harder to build more things because you need money to build more things. It's completely inverse environment from what we had before where money was free, which means I could just expand and grow and grow and grow because my, monthly liabilities were very, very low, right? I'm borrowing money for very cheap. Money was quote unquote almost free. Now money's very, very expensive.